Hello everybody and welcome to the May 2020 Market Insights video. This is the sample portfolio review piece. A real quick introduction. My name is Goran Ognjenovic. I am the founder and chief investment advisor for Independent Investment Advisors. We're a independent wealth management firm located in Portland, Oregon. We focus on financial planning, financial advice, and investment portfolio management. A quick agenda review. So for those of you guys that have watched my videos before, what I had to do in May is I had to split up what used to be one video that had these three topics, right? The economic indicator review, and then sample portfolio review, and then the market review. Those are now three different videos. The one video was getting kind of long, so I broke them up. So this video is about sample portfolio review, and then the other two you can find out on Market Insights blog. I would encourage you to go check them out. Before I move forward, here's a standard disclaimer. Everything I say is to be used as educational tools, should not be construed to be investment advice. Investment advice needs to be tailored to specific investor needs, and none of the information contained in the Market Insights blog should be construed to be investment advice. There's a high degree of risk in investing and trading. We assume no responsibility. Principles of investment advisors may or may not, at times, directly or indirectly hold positions in securities or derivatives that we mentioned in these comments. I'm going to let you guys read through this. I'll give you a few moments here, and then we'll jump right into it. All right, so general investment comments. For those of you that are watching this for the first time, we manage really two types of investment programs. One is an allocated portfolio and a tactical portfolio. Allocated portfolio is really a mid to long term investment portfolio, right? So your typical retirement portfolios, maybe some business investments and things like that. It consists of appropriately allocated investments into money managers, mutual funds, bonds, fixed income ETFs, that kind of thing. Tactical portfolio is really for an aggressive investor and a short to mid-term investment goal. It primarily consists of actively traded US ETFs or individual stocks. It also uses margin, and I'm actively engaged in managing positions based on what's going on in the equities market, right? Some other general comments is we're always invested, but our asset allocation change based on what's going on, right? Sometimes we're more invested in equities, sometimes we're more invested in fixed income, sometimes we're more US based versus global, and things like that. One of the major advantages we have is that we're very small, and we don't have to anticipate what market's going to do. We can sit here and watch the market and then react to what market is doing. We don't have billions and trillions of dollars to move through the market, and primarily we use chart, fundamental, technical analysis to make our decisions. All right, so let's talk about our sample portfolios. As I mentioned before, these are actual portfolios, right? I removed the names to protect the innocent, but these are actual portfolios that I manage on ongoing basis every day, and I included them here just to give you a sense of how different portfolios behave, right? This is part of that investor education. I want to educate people what to expect in terms of when they get aggressive with their portfolio versus conservative with their portfolio. So there's three portfolios that I'm tracking. One is a brokerage account set up for young children, right? So it's got a 30-year time horizon that started really January 1st of 2019. This particular portfolio has continuous monthly contributions, right? You've got parents contributing on a monthly basis, a very, very aggressive allocation, and it uses margin, right, to take advantage of cheap money and market moves. Retirement IRA portfolio. This is a 2025 time horizon, again as of January 1st of 2019. It does have annual contribution based on annual maximums, right? And then it's a mid to aggressive allocation because we still have a 20 to 25 year time horizon. And then a third portfolio that I'm watching is, or that we're going to look at here, is a retiree portfolio. This particular client's already in retirement as of January 1st of 2020. They anticipate they need 20 years or so of income and capital preservation. They're not making any more contributions, and it's a very, very conservative allocation. Right? So before I jump into the individual portfolios, I always show the advisor's view, right? So this is my perspective, all of my portfolios aggregated, how they behave. And as you can see, the advisor's view is, let me get a pencil here, right? It's 51% fixed income, 41% equities. We got some real estate and some other things. Very, very heavily weight in North America, a little bit of Europe and Asia, and then fairly distributed across different sectors and industries, and obviously quite a bit in U.S. Treasuries. So from my point of view, right, all of my portfolios, from most aggressive on the left to the most conservative on the right, down here is how they've behaved so far in 2020, right? So January, February, March were contraction months, right? This is in percentages, month over month percentages, and then pretty nice rebound in April, pretty nice rebound in May, and then essentially year to date we're sitting at roughly 2.6%. These numbers do include dividends as well, right? So on these contraction months, right, you had dividends that were being reinvested, and then you've got kind of a rebound here. All right, trust portfolio. Again, let me switch color here. So this is a portfolio set up for young children, huge time horizon, continuous contribution, very, very aggressive allocation, right? And we use margin. And so look at this weighting here, right? It's 92% in equities compared to what we just saw, which was 41%. So huge equities allocation, a little bit of real estate, huge exposure to North America, some Europe. On the sector side, large exposure to technology, right, and healthcare. Those are kind of the growth engine, and then consumer cyclicals is where you would expect to see aggressive portfolio allocated. Here's the performance, right? Substantially different performance in compared to kind of the advisor view, right? Contraction in January, 11%, a little over 11% contraction in February, 30% or 25% contraction in March, and then rebound in April and May. And as of June 5th is when I'm doing this recording, this portfolio is still in red for the year at about 5%, right? But I think at the last video, this thing was down 44%. So huge swings, right? And that's what you would expect to see out of an aggressive allocation and a leverage portfolio. Moving on, IRA portfolio, right? Again, a reminder, this is a 20-25 year time horizon. Annual contributions based on maximums, on annual maximums, and then mid to aggressive allocation. So we got 68% in equities, 18% fixed income, 8.5% in real estate. You can see this one is a little bit more distributed across the world, right? 78% in North America, a little bit of Asia, a little bit of Europe. and so forth. Pretty decent distribution. You know, a little bit more heavy on financials, as for some of that income, right? And then offsetting that with technology. And then here's how it's behaved so far, right? Contraction in January, contraction in February and March, and then a nice rebound in April and May. And so we're sitting at 553% negative for the year. And then retiree portfolio, obviously extremely conservative, right? 84% fixed income, 14-15% in equities. It's 95% North America, right? A lot of treasuries. If you look at this, right, a lot of treasuries. And then, you know, utilities, some financials, consumer non-cyclicals like the staples, and then telecom, right? These are all sort of the sectors that are defensive, that generate income for a retiree portfolio. And then you can see down here the behavior year to date. You know, very small contraction in January, very small contraction in February, a little bit more in March, and then rebound in April and May. And basically, it's even for the year, right? So, you know, my goal here with these guys is to show. A lot of times I talk to people, right, clients, and they don't know what to expect, right, and more importantly, they don't know how they would react to moves in asset values, right? And so you can see these three portfolios, very different compositions and very different set of expectations, right? So something just sort of to calibrate on how different things behave in different market conditions. And then the last thing I want to share is the tactical portfolio. I mentioned, you know, up here. I'm gonna jump back. Right, we ran the allocated portfolio, which is the three we were looking at, and then a tactical portfolio, which is really actively traded every day. So tactical portfolio did 6.64% in January, had a low contraction in February, 14% in March. As you can imagine, right, since it's a tactical portfolio, when market volatility goes up, this portfolio will show outsized gains, right, or outsized losses. It can go both ways. And then, you know, as the volatility starts to stabilize, we sort of go back to normal numbers at, you know, 6.5% gains. So I would expect to see sort of 6-ish% return on this one. I think we're going to see in July and August, right? They're probably going to be smaller because the volatility goes down in the summertime, but and then it should pick up into the rest of the year. Anyways, guys, again, just an educational video to help you understand how different portfolios behave. If you've got any questions, please give me a call or shoot me an email. I will do my best to respond. And if you're looking for some help with this, do give me a call, and we can have a conversation to see if we can work together. All right. I hope you have a good day.